Hi, I'm Mark Honeybone from Property Ventures, and welcome to our weekly podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. This is a free service from Property Ventures so that you can keep current and learn from some of the best around New Zealand. To check us out, take a look at propertyventures.co.nz. We hope you enjoyed today's podcast. Hi, and welcome back to another podcast with the New Zealand Property Podcast and Property Ventures. Today we have John Rowe, a first-time guest from Gilligan Rowe & Associates, where he leads the Business Services Advisory team, where they offer advice and accounting services to a large, diverse client base. John specialises in providing practical and technical expertise to business owners and professional practices. John regularly presents to property groups, business owners, trade associations and national business development organisations. He has a wealth of expertise in businesses, setting up structures and a lot more than just that, and we'll hear all about that soon. So get ready to learn, and I hope you enjoy the podcast. So welcome to the podcast, John.
Thanks, Mark.
So people get to know who's talking to them today. Do you want to tell us a wee bit about yourself, John?
Geez, I thought you'd done that already.
Any intro, tell us the real stuff.
The real stuff, okay. John, I am one of the founding partners here at GRA. I have three little kids, spend my lot of time just away from home in the office, trying to help clients set up the right structures, get their businesses right, make sure they really have every opportunity available to them, and get to keep everything that they've got and get to keep everything that they make going forward.
Yeah, absolutely. So on structures, and more particularly correct structures, I know there's a lot of different structures out there. They're obviously pretty important. So why are the main reasons?
I think one of the main reasons, Mark, is that when you're looking at structures, you've got to look at them quite holistically. First of all, people sort of automatically start thinking of tax.
Yeah.
And tax seems to be the driver. Yep, I appreciate we all have medical condition about paying tax. You pay what you have to pay and no more. But structures are more than that. With structures, you've got to look at them quite holistically. So you're looking at tax, asset protection, because as I sort of commented before, you want to keep everything that you've got and everything that you make going forward. You know, getting into property is exactly the same as getting into business, so it's got some risk. So you want to make sure that you've got some good asset protection there. At the same time as asset protection and tax, none of those work well if you don't address things like, estate planning, relationship property, because of course that's one of the biggest risks out there. And also making sure that the accounting and all the other needs all work nice and neatly together.
Right, so it's not just if you go to the accountant looks after the tax side of it. You go to your solicitor, they look after the protection of assets. So you amalgamate them both together and get the best result for the client.
Yeah, you find if you do it in isolation, it doesn't work. Lawyers are very I'll say very good. Most of them are good. In fact, I don't know if you're aware that lawyers didn't have to do continuing education until I think it was last year. So you could get you could leave law school and 20 years down the track not have looked at another thing.
Wow.
I'm sure there weren't many lawyers like that though, but in my experience, I think there may be a few. But that aside, you get the best approach by looking at it holistically. You need somebody who takes a good legal but also a commercial approach to these things to get the right solution. It's not just a cut and dry, and it's not something you do, I'll do the tax on one side, I'll do the estate planning on the other side, which is sort of a traditional legal area. They all have to meet together, and you only get that well by working properly by doing it at the same time.
Right, good stuff. So just for the pretty newer people listening to property, is it just the same structure for all? You know, if you're a developer building an apartment block, or you just want to buy one property forever?
Hell no. I wish it was to make my life easier. No,
you wouldn't earn as much though, John. You know,
everyone has a unique position, and there's a lot of things that affect people's structure. Right from are they self-employed or are they on a salary? Are they in a blended family? Have they inherited a bit? What are they doing? Are they buying to hold? Are they trading? Are they doing both? Do they have another business operating? There are so many different things to take into account that sadly, no, there's no cookie cutter approach.
Yeah, and that's obviously not blowing your trumpet or business, but why you want to go to an expert to get it right, especially if you are in that development or whatever role. We'll come into that afterwards. But.
Yeah, absolutely. But it's one of the biggest problems we see is that people, get the round the bar conversation, they get the advice from their friends and that sort of thing, and we spend a bit of our time going, well, no, that's not quite right, we need to fix it. And it's always much more expensive to fix things and to correct things than it is to get it right at the beginning.
Absolutely. Okay, so what are some of the more hidden problems you see when investors haven't sorted their structures out correctly?
Some of the big things, obviously, tax, missing out on things. Private non-tax deductible debt, we call that bad debt. Good debt is debt that's working for you, that's tax deductible. So, you want to maximise your tax deductible debt and minimise your non-deductible debt. Also making sure that, people don't expose their assets unnecessarily, considering things like banking structures at the same time as your asset protection, that thing, because you don't want your eggs in one basket, you want to minimise your risk. And, as I said before, you want to protect what you've got and protect what you make going forward. Also, some of the common things is that we see people not being able to income split with their partners or not taking advantage of lower tax rates. And, to the extreme, going out and marrying dropkicks, whether or not that be both sides. It's the easiest way to give away half.
So you sort of will sit down with someone and look at their, I suppose, life situation, where they are with their businesses and their relationships. When you sit down, it's not just all about the property.
No, it's not only about it's also about family, their situation. Do they have kids? Whereabouts are their parents? They got income offshore or onshore, assets offshore, onshore, all of that sort of stuff as well. And make sure that they have the right structure. Look at what they're doing now. Look at the paperwork. Look at their, if they've got trusts, look at that, because the law constantly changes. Structures aren't one of those things that you put in place and 20 years later you pull it out. You've got to be constantly looking at them. The law changes; they need to change with you.
Yeah, in fact, I just read in the newspaper last night. It's quite a common problem, apparently. I think when your mum and dad give Johnny a few $100,000 to get in their first property, and then mum and dad separate, and all of a sudden, and there's nothing in place to say what's going to happen in any situation. So there's no documentation.
Yeah.
And apparently it's quite a common
never
problem.
ever give your kids money. First of all, always lend it to them.
Yeah.
And the next thing is that if family are one of the most complicated things to deal with. There's nothing wrong with doing business with family and friends. You just got to make sure that you document it like everybody else. You deal with it like a really difficult third party that's got nothing to do with you. Document the living daylights out of it. Make sure that you know where things stand. But also, if you are, involving family, it's very important to talk to the other members of the family to make them aware of what's going on. Because otherwise, you have issues with children, see that there's favouritism and that sort of thing. So that's all sorts of things that need to be addressed. But also, what people miss is that the parents will get their structures right, or the children will get some structures put in place. But if you've got things that are happening, not just with the lending, but potential joint ventures or partnerships and that thing, it's very important that they both work well together.
Yeah, I suppose in the family thing, as you're saying, certainly right. If it's better to sort out, or at least the other family members know what's going on when mum and dad or grandma and granddad are alive, not when they're dead. Because So the issues are sorted.
You don't want any surprises coming out.
No, it's a wee bit. So what about the investors that are listening here and they go, oh, well, damn, I bought a couple of properties 5 years ago and I never set anything up. It's too late now. What would be your response to that?
It's never too late. And anyway, if they had set things up 5 years ago, I'd be saying, take the opportunity. The market's changed a lot. The law's changed a lot. Tax, everything's changed a lot. Sit down, go through it, make sure that what has been done is still relevant. I mean, I'm still seeing people that never did anything back at the old LAQC days. Right. So they're long since gone. People's accountants never gave them any advice. They didn't take the opportunity of any restructuring, and they sort of left in limbo land. It's a prime example of why it's very, very important to sit down and regularly and get advice. And if your accountant's not giving you advice, change accountants, change lawyers. Right. You should always have somebody that you can ring up and ask. And, it's a prime thing we say to clients here, no question's a silly question.
Absolutely. I suppose that's was that normally what annually happens when you get your accounts, obviously, for the previous year? Yeah.
No, at GRA, we work off a fixed fee scenario, so we don't charge for quick phone calls, emails, meetings, and that sort of thing. So if you're not going to be charged, no question's a silly question, and you should be ringing up if you're going to be doing something or you're unsure of something, pick up the phone.
Right. Good advice. Okay, so what about the investor who just wants to buy, one rental property they think that's what they're going to do, and maybe that's all they do? Do they need to set up a whole lot of trusts and companies, or so it obviously costs a wee bit of money when you do that, and compared with someone that obviously wants to do a lot more?
Well, it's an interesting question, and you may have an investor that's got one rental property, but what else do they do? So are they on salary and wages? Are they self-employed? Do they have a bunch of other businesses going on? If they are on salary and wages, what is their situation? Do they own their own home and that thing? So you can get a position that is very looks straightforward on the surface, i.e. a rental property. And yes, it can be dealt with very, very straightforward and very simply. But again, there are some opportunities and some things that you need to make sure that you get right. For example, banking structures, separating risk between banks, minimising your exposure, because banks constantly change their rules. I mean, we're seeing that a lot at the moment. Yeah. And it's having those things locked down and minimising that risk. And also, there's huge opportunities that if you do have a rental property and nothing's been done with it, or it's sitting in your own name and that sort of thing, you may have some opportunities around debt restructuring, taking private debt, making it tax deductible. Maybe you'd have advanced a lot of money against your rental to pay down principal or renovations and that sort of thing. So we can look at all of those.
Right.
And there may be lots of opportunities for somebody. So just before you jump in, there's those sort of opportunities can amount to tens of thousands of dollars a year in benefits to people.
Yeah, absolutely. So it's a matter of getting in front of just getting a meeting. You find out basically,
Yes.
And it might be simple.
Yeah.
Simple structure. It might be something you'd never thought of.
An hour to an hour and a half of time well invested.
Yeah, definitely. Okay, and on sort of a similar with the other or some other type of people listening, for your first time developer, as in someone who's been investing, they've got some property, they now look at it going, okay, let's do a development, let's turn one into 3 or 10 or build an apartment or whatever it might be. And I suppose that it comes down to people wanting to start a business also. Is what should they, apart from coming to see you, you'll say, what sort of things should they be thinking about?
They should be thinking about things like what is their plans now and where are they heading down the track? Do they intend to, for example, develop a trade for cash flow and build a whole portfolio for long-term investing, or long-term, for example, a surrogate superannuation scheme down the track? Also, how do you do that and maximise cash flow? So you're maximising cash flow around debt structures, around tax, around income splitting. There's all sorts of things. And don't forget that when you start to get into trading as well, you start to get into I won't say a much more complicated league, but there are far more risks. You've got the Building Act issues, you've got all sorts of bits and pieces that you need to be able to deal with and make sure that it's very critical that you get those structures right.
Yeah, I suppose that risk is the big thing when you start developing and, as I said, securing what you've got before you start, making it safe.
Yeah, there's also a lot of people that think they are doing a development when they're not. So you may be subdividing a section to build a couple of houses on it for long-term rental. Now, that isn't necessarily a development for tax purposes. It may be just building properties for rental, and so there are some exemptions for that. So, it looks like a development, smells like a development, but it's a long-term hold.
And again, bar talk or barbecue talk is people go, you're a developer, you're building 3 houses. And, well, as I said, no, you're actually just an investor getting some better cash flow when it's all done and some equity.
That's right. And one of the biggest things, I did a presentation last week to a group of people. I still hear people say, I've held a property for 10 years. If I sell it, I don't need to pay back depreciation or anything like that. Fallacy. There's all sorts of myths out there.
Yeah, no, that's all good. Okay, so if you're someone out there who's listening, they don't have any structures sorted out now, they're looking at buying maybe their first investment property. What sort of advice would you also advice, what would you tell them now would be the best thing? They can either come and see you beforehand and set up, or if they you can put and or nominee on the sale and purchase agreement. How long should you have between that and when they settle so you can sort what they want out?
You want to have as much time as you can to get things sorted out. So I'd be saying to people, you can have and or nominee on agreements. That means that quite simply you can go along, you can sign something up in your own name and then nominate where it goes to later. The only thing is you need to be very careful with that for contractual liability, and that's saying you're far better to have structures in place now. It doesn't cost that much compared to the cost of a property. Property is one of those things that you've got large dollar value transactions, and even if you get a little bit wrong, a little bit of a big number is still a big number.
Yep.
So my advice would be to pick up the phone, give us a call, look, it's not going to cost anyone to sit down with us and have a chat and see where we're going and seeing if we can add any value to it.
Right. Yeah, before we let you go yet, though, John, just one question. In the last or recent budgets, government talking about the IRD have been given a whole bundle of money to chase up investors and property investors and other businesses too, I guess, as well. Do you want to expand on that and what's happening a year or so later? Is that happening and you've seen anything in the practice here?
Yes. What we're finding is that Inland Revenue have become a lot more aggressive and proactive in all fields, actually, right from chasing outstanding tax returns. Clients never used to be rung up unless you had a few years outstanding and that. So you only need to be a few days past the due date, and that's when you're getting phone calls by Inland Revenue, because of course the quicker tax returns are filed, the quicker they know if there's debt outstanding and the quicker they can collect it. But we're also finding them becoming very assertive when it comes to particularly property. They are using the resources such as the data that they're collecting out of the Land Transfer Office. They are also, now if you buy a property, you're giving your IRD number, so it's even easier for them to track. And they are really targeting people that may be saying that they are long-term rental investors, but there's been a history of them buying and then selling probably a little bit more frequently than what would be the norm for a rental investor, and they're investigating those sort of people as potential property traders, and that has repercussions of both income tax and potentially GST and that sort of thing. There is a lot more risk review, so not necessarily more full audits, which an audit is when IRD come in and they go through everything. There's a lot of risk reviews going on at the moment where they target a particular area that is of interest to them. So that may be, they have identified that you have bought and sold some properties and they want information specifically about those properties, but they may not care about any other business activities that you've got going on and that sort of thing at the moment unless an issue comes out of that. We're also finding from a...
would that just be something to do with a GST return that's happened or not, or just be something they've identified somewhere on the system and go, hey, let's ask these questions?
Yeah, they identify their information from all sorts of places. First of all is obviously statistical analysis of the tax returns that are being filed, the information that they're collecting from other government departments such as Land Transfer Office, information that they collect from the banks. So, IRD can get information from the banking system just by sending them a fax or an email to say, please give us the data, etc., from your bank accounts. So it's very, very easy for them to identify issues. They also, quite often, people's names or their companies pop up as a result of an investigation into something else. So we've had a bit where family members have been investigated on something and something, that IRD have been really concerned about, and therefore they go and launch audits and investigations into the rest of the family or relatives, associates, etc., just to see if they're also involved. And right down to one person whose brother was being investigated, and they identified some problems with his brother, so they then had a search warrant against the other brother's house. Went in there in the early hours of a Saturday morning, detained the family for 10 hours while they searched their property, just for cash or for other business things. So that involved the police, etc. Just because another family member was involved in, there was a historical link about sort of 15, 16 years ago in a business that they owned jointly, but nothing since that stage, but they still went down that track. So, very, very aggressive, protecting their positions.
Well, that's a wee bit scary, chasing things up that far down the track. So the old adage of in the old style accountants going, you'll be right, you can sell or trade, 1, 2 or 3 properties, and then you've got to be careful.
Yeah.
I guess that's no longer the case.
Well, it has never been the case.
No.
There's never been any rules around, how many properties can you buy and sell, or how quickly can you buy and sell them. It's all about intention and making sure that intention's right. And don't forget that IRD always have the benefit of hindsight. So you might have had some valid reasons at that time to buy those 4 properties and sell them within the last 18 months and buy some more and sell them. And they may be completely unrelated and absolutely authentic, but all Inland Revenue are going to see is that you bought and sold a bunch of properties in a very short period of time, and they will be interested in that. And then you've got the hassle of dealing with it and that sort of thing. But just as again a little bit of a side note, what we find with clients that are coming on board with us that in the process or in the middle of an IRD investigation or a risk review is that just how poorly some people handle it. It's the big thing I can stress to people is that dealing with Inland Revenue is as much about the law and tax as it is about managing the relationship with the auditor or the person from the department. You'd be surprised how many people treat the person as the enemy and are rude to them. They never return phone calls, or they abuse them and that sort of thing. And it's quite logical if you think about it. What's that person going to do to you? Are they going to be lenient or not? Because you've always got the problem of dealing with the big issues. But quite often I've found is that most Inland Revenue Department auditors, if you deal with them properly and you manage that personality, that HR part, that an audit can go quite smoothly, even if you have some quite major issues. If you're upfront about them and you don't try and be shifty about them and that's when you deal with it, then quite often you'd be amazed as to how flexible the department can be. That's different, of course, if you completely brass them off and you've been fighting them and scrapping them and calling the person nasty things to their face, then they are probably not going to use any discretion and they'll be out to squeeze every cent out of you.
Absolutely. And with the reviews there now, which are just specific contracts or whatever they might be looking at, or something particular, are the audits, are there many audits as there used to be, or are there still more audits? Or
there's probably about the same number of audits, but IRD are now using that risk review process is a quite focused approach. Normally historically what would happen is that you got an audit, they'd come in and they'd look at everything. But they're using the risk review process to go, we're concerned about this one thing, we want to get some comfort around that one thing, and everything else was sort of, we don't worry about that.
And then I guess if they pick up something or more from that, then they might do a full audit.
That's when they go digging. A risk review can be relatively inexpensive to deal with depending on what comes out of it. But, a full audit is a real pain in the neck.
So it'd be particularly nice if they just do a review, I guess, of helping them to find what they're after and deal with it.
You don't need to state the obvious. If you've got an accountant, use an accountant because a lot of people don't understand the intricacies around things and around the tax law and that sort of thing. One thing may look like something, but actually from a tax point of view may be something completely different. So what a lot of people do is that they try and save professional fees and that sort of thing by dealing with the audit themselves, whereas there's a reason you deal with accountants and that sort of thing, and that is to, and these times, the times that you really need them, well, first of all, your tax return should be right. But secondly, you need somebody who's going to defend that position and know what the consequences of various things are and can sit down and be reasonably blunt with you if they do find an issue. To say, well, this is how we'd recommend you deal with it, rather than just hiding it or dealing with things. Because I find it in people naturally like that. If a person asks you a question and you're not quite sure of the answer, people keep talking and keep giving away more information that can potentially put them in the hole even further.
Yeah, right. Yeah.
So
it's no different than going to court without a lawyer, is it? The same scenario, I guess.
Just use the advice, put your hand up, and tell IRD you've got an accountant to deal with them.
Great. Okay, so great advice there. If you do give an audit or something similar from the ID, go to your accountant and let them know first of all, because they might steer you in the right direction anyway.
And also, is to also tell Inland Revenue that you do have an accountant and you prefer them to deal with the accountant.
Yep.
As the accountant knows more about the accounts and what's happening there, and they should be their first point of call.
Can you, just on that, comes down to a lot of people listening, it comes down to the money always.
Yep.
Can that accountant give them just a guesstimate of what it may cost to deal with the ID, or it depends on the experience?
Yeah.
And I know every case is different. But
it's really hard because you generally don't know what you're heading into. But you can certainly give people a guide as to, if it goes to this stage, how much that is likely to cost.
Yeah.
And then you can sit down and, well, if it goes any further, this is likely the next step, and if it evolves, what happens from there. But it very much does depend on what is happening.
Yeah.
And what they're investigating.
Yeah, absolutely. Okay, right, John. I know you see a lot of good cases around here, and you seem to get all the difficult ones. I don't know what I've noticed. So, what have you got a good story to tell the listeners today about something that maybe what they could think about or should have done or might not have done?
You'd be surprised what comes over our desks. You'll regularly have people with outstanding tax returns and that sort of thing come in, and they're embarrassed because they haven't filed a tax return for the last year, or they may haven't filed them for the last 2 years. And my comment on that is that is nowhere near the worst that I've seen. I've had somebody come in to see me who's had 20 years worth of financial statements across multiple companies that had I think 30 or 40 investment properties, had some businesses on top of that. Had IRD had started to make some phone calls. So you'd think that somebody who hadn't done financial statements for 20 years and paid all their employees in cash, hadn't paid any GST, had been trading property, hadn't paid any income tax, etc., would be a bit concerned about a couple of little calls and quite motivated. But when I pointed out that I think there was something like 12 different entities and 20 years worth of financial statements. Wow. So you multiply that out. Wow. There's a lot of work to do. And I sort of quoted him a fee to sort it out and resolve it all. And he looked at me and he said, how much that was. And, in the scheme of things, it was less than the capital growth on one of his properties. And realistically, if he'd done and been a compliant taxpayer the whole way through, that it was very likely that many of the properties that he had now he probably wouldn't have had, because they've been bought out of the tax that he should have been paying.
Yeah.
So, he'd had the benefit of that money all the way along, but he couldn't see it that way. So despite the fact that he had IRD starting to pay some attention to him, he decided to ignore our advice and do things quickly. And rather, he went out and tried to employ a bookkeeper to try and bring it up to date. And 6 months or 7 months later, I phoned him to say, what's happening? Do you need a hand, etc.? And he says, it's a nightmare here. I need more time. IRD are being entirely unreasonable because they're not giving me more time to do it. And they've given me a month, otherwise they're going to start looking at prosecuting me. It's extremely unfair. I'm being hard done by. And he just sort of looked at the person and went, realistically, you've had 6 to 7 months by the time since you've seen me. It could have been done. It could have been all put aside.
Yeah.
And it was just excuse finding and sort of being a bit like an ostrich and being cheap. Now, when you have a look at, you've got that many properties, and if you've got tax and that sort of thing outstanding going back that far, by the time you take interest and potentially penalties and the court tax in place, that could add up to a huge amount of money.
Worth as much as most of his properties are worth.
And he was risking everything.
Yeah.
Just for the sake of, it could have all been cleaned up relatively painlessly.
In that situation, I guess the more you can show you've been proactive, getting someone professional to do it, the ID will sit back and listen then.
If he had engaged us 6 months earlier, we could have then phoned up the person at IRD that he was dealing with and said, look, there's a hell of a lot of work to do here, but he has engaged somebody who's trying to sort it out. Can we work with you and get an extension of time? I've never known Inland Revenue to decline that.
Mm-hmm.
It's an inherently reasonable request, and all they want is a compliant taxpayer out of it.
Right.
But no.
Geez, my question would be, how did he get away for so long with the IRD, out the IRD, knowing or finding or...
And historically, Inland Revenue were quite, I don't want to say slack, but it surprised you as to how people could have outstanding money for years without them chasing it and that thing. It's turned 180 degrees now.
Yeah, that's why they spent all the millions of dollars to employ people to chase, and now they're finding it, so that won't happen, I guess, in the future.
Yeah, but also we're finding things where people have been rung up and they've got companies, for example, owing money to IRD, and they owe some money themselves, and IRD, for example, will only enter into payment arrangements with them individually if they personally guarantee the company's stuff.
Right.
Which is, to me, a little bit immoral, and I think if the people got some proper advice, they wouldn't be entering into those agreements with the department. So, I can't stress the importance of getting some good legal, accounting, and commercial advice, practical advice as to what is the best way forward. Because it's great being right legally, but you've also, got to put together a deal.
Yeah. No, I've seen it very closely hand myself with John once, so in recent years. So, okay, well, John, hey, thanks very much for your time today. You've given a couple of interesting cases to finish off with to keep people interested there, but also more practical stuff right at the start. Also, of people want to look at their tax return or structures or whatever they want to do, and people know how to contact you by looking at our website under the podcast there and find you at GRA anyway, or what's it, gra.co.nz?
gra.co.nz, yes, nice and simple.
Nice and simple, as tax should be.
Right? As life should be, yes.
Good. Okay, well, it's been good to have you on the podcast series the first time. I'm sure we'll get you back one day too. So, hey, thanks for your time.
Thank you very much. Thanks for having me.
Okay, don't stop listening just yet. We hope you enjoyed the episode today with John. And we would appreciate it if you rate or review this podcast. You can go on iTunes and simply go to iTunes and review it. Or if you have it downloaded on your phone, please rate or review it there, and that'll be great. Hey, thanks for your time. We'll be back next week with another podcast.